Hey, what's up everybody? In this video, we're going to talk about what happens when you enter an invoice in QuickBooks. Okay, so I know it's pretty simple to use QuickBooks. You go in, you type in your customer, you create an invoice, you choose the items that the invoice are for, and then you email it to them, and later, hopefully, they pay you for the invoice. There is a lot of accounting that happens behind the scenes that you never see in QuickBooks. And if any of the items that you chose for your invoice or your chart of accounts, if any of that is set up incorrectly, it can drastically impact your financial statements and make those incorrect. But in this video, I just want to show you what actually happens behind the scenes when you create an invoice. So you're going to create an invoice in QuickBooks, and it's going to make a journal entry that you really never see. But with accounting, that journal entry has to get made. There's no way to just do an invoice for $1,000. There has to be balancing entry and everything that happens behind the scenes. So here, instead of equipment, I had that for a different example, but instead of equipment, we're going to have accounts receivable. So perhaps you know that term, but that's just the money that your customers owe to you that they have not paid yet, but that you have billed them for. So you type in an invoice in QuickBooks for $1,000. Your accounts receivable is going to increase by $1,000. They now owe you that money. You can pull your accounts receivable report and you can see Joe Smith owes me $1,000. But that $1,000 isn't balanced because, again, double entry accounting. Every entry has to have a balancing entry. So when you record that $1,000 in QuickBooks, it's going to take that $1,000 and it's going to add it as income to your income statement. Okay, so you've created this invoice, and what QuickBooks has done is it has added $1,000 to your accounts receivable, and it has added $1,000 to your income. So this transaction is balanced. $1,000 and $1,000 are balanced. Now, this is a debit and this is a credit. You're going to want to jump over and watch the video on debits and credits. Don't let that terminology mess you up. But basically, we've increased accounts receivable and we've increased income by the $1,000. That keeps us balanced. It's double entry accounting again. And this is what happened behind the scenes. Now, there is a button in QuickBooks. There's a setting where you can change from accrual to cash basis. Now, when you're cash basis, you only report income when you actually receive the money. Doesn't matter when you earned it. It's when you receive it. That's the cash basis. The accrual basis is when you actually report accounts receivable and your income goes up at the time you earned the money, whether you actually received it or not. So that switch in QuickBooks will toggle back and forth your financials to where under the cash basis, even though you have an invoice in your customer center and you have an amount due to you if you run an accounts receivable report of $1,000, your balance sheet and your income statement are not going to show these. They're not going to be on there if you run those according to the cash basis. It's just going to reverse this transaction as if it never happened, and you're not going to see them. Now, under the accrual basis, you'll have $1,000 of accounts receivable, an extra $1,000 of income, and everything will still be balanced. What happens a lot in QuickBooks is sometimes people will, well, let's jump into this real quick. So once this person pays you back, okay, so what happens, not pays you back, but once this person actually pays this invoice, you might think you have income, but you don't because you've already recognized the income. So when they pay you, you increase cash by $1,000, you decrease your accounts receivable by $1,000. So again, your entry down here, you're going to increase your cash by $1,000 and you're going to decrease your accounts receivable by $1,000, or QuickBooks is going to do it. You're not going to do it. You're going to go into receive payment. You're going to type in the date, the amount they paid you. You're going to apply that to an invoice. And what it's going to do is it's going to say cash of $1,000 went up, accounts receivable went down. We're still balanced. Everything's still good. Nothing hit your income statement because that $1,000 was already on your income statement at the time that you invoiced it under the accrual method. Even if you're using the cash basis method, QuickBooks is going to do this because you're tracking your receivables to know who owes you. But when it gets to the financial statements, QuickBooks is just going to reverse all this and not show it to you because you're reporting your financial statements on the cash basis. All right. But this is the accounting that happens behind the scenes. My name is Brad. I'm with Wooten CPA. My goal is to bring peace to your finance and tax responsibilities. Don't forget to subscribe to the channel. Please hit the like button and then the bell so that you're notified when new videos come out. Thanks for watching.